Okay, welcome everyone. I'm pleased that we have two really exciting speakers today. Our first speaker is David Lane. David Lane is a venture capitalist who's been in this business for many years, since 1987. I first met David when I started my first startup company, and back in the internet boom days, when we went out to search for funding, Fetch Technologies. He was wearing this shirt.
Shirt for this day.
Very nice. He was one of the co-founders of Fetch. And I remember actually going out and trying to raise money and talking to all these venture capitalists. And one thing that really stood out was David Lane was by far and away the most helpful venture capitalist that we met with. Well, most of them would just sort of look at your business, maybe tell you what was wrong with it, and say, yeah, bye. And whereas David actually really sat down with us and came to visit, spent a lot of time talking about, what do we actually need to do to really create the sort of a compelling model that a venture capitalist would actually want to fund it. So he was extremely helpful then. He's now on the Viterbi Board of Counselors, and so is extremely valuable for the larger Viterbi organization in terms of providing feedback and input to the School of Engineering. And David has just a tremendous amount of experience. I mean, he's got all kinds of things in his bio that he's done over the years. He's managed $3 billion of private capital, which I think is a pretty impressive number. He's going to talk about creating a startup. What does it take? And then after David's talk, he's going to introduce our second speaker, John Devine.
Thank you for your kind words, and thank you for inviting me. ISI is really a wonderful institution, and ICT and others at USC. I get so excited every time I come on campus or come to one of these institutes. It gives me huge pleasure. And the passion for me is really commercializing deep technology. And I've had the pleasure of commercializing technology out of USC multiple times, Stanford, Berkeley, the Post-Naval Graduate Institute. I've got one that just came out of MIT, their media lab. And it's just really awesome to deal with incredibly smart people who are trying to solve difficult problems. So I love it. In the next short period of time, probably about 15 minutes, I'm going to walk you through what to think about before you start a company. And so when I like history, I love history. And when you look at different turns in history, if you study them from my perspective, you start to learn about how do you avoid some of the problems that have occurred. So in creating a startup, even before you get going, what do? Well, let's look at, according to CB Insights, who spoke to a lot of startup founders, why do they fail? And so they've broken it down, 42%, no market need. Now, as we go through this list, I'm not going to go through it extensively. I think you'll see there are some themes that repeat, come and go in different ways, right? But basically, if you can't find a market need, you don't even have to have a product or a service to find there's no market. So what this tells me is for those who are contemplating a startup, get market feedback, right? Get out into your potential customer base and see what are their requirements. Because one of the biggest challenges, especially for the research community and the university community, is developing technology for technology's sake. That's wonderful, unless you want to have a successful company that's created out of it. Also, I would suggest, as government funding gets harder, dual-use technology becomes increasingly important. And so if you're able to tap not only into the government world, DoD, et cetera, but also into the business world, maybe the consumer world, you will have a better chance of getting funding for different projects. So no market need, super critical. Second one, running out of cash. I'm going to come back to that in a minute, because for every startup, unless you're running a consulting business or an unusual business, everybody needs cash. So let's come back to that. The third one, the team. The team didn't fit the opportunity. What does that mean? Well, it probably means things like either that you don't have enough knowledge of the marketplace, or you didn't have enough knowledge about the technology. So if you build a team, and a team doesn't mean you hire everybody, it could be advisors, it could be consultants, it could be friends that help you. There's a lot of things that you can do to get the right team. And then at some point, especially once you start a company, then it's how do you bring them in at the right time? So in other words, if you haven't even developed your product yet, to have a salesperson sitting around, that's expensive, right? So you've got to think about what skill sets do you need on your team and when. Okay, you've got outcompeted. Well, to me, that just says you actually didn't know your customers, and your competitor found better solutions than you did, right? And you go down to pricing and product issues, especially where there's a hardware component. Those are all things that can be researched before one even starts a company. So you know what price points you have to hit, even if it's software as a service or a physical product, a service, you can actually do your due diligence before you even start, right? So it's doing the homework before you show up for the test. And so poor product, maybe that's just another way of saying your product didn't meet the needs of the customer, right? You've got business model issues. A lot of that can be determined early, not always, but typically it can. You can have ideas about what other companies are doing maybe in other segments as far as what will work here. So you postulate, you create a business model, right? Poor marketing. Well, that's after you've gone a ways down the path that you're really going to get into marketing. Okay, and you've got ignoring customers. And that's what's interesting to me, and I've seen this in many companies, is you sell a company once and then you never talk to them again. It's like, how are they going to be happy? A lot of people do that. A lot of startups do that. It's like, wow, that's kind of crazy. Product. And so there's a bunch of themes that show up here. If you can read through them all, I don't have to go through them extensively, but it's if you really think about it, there are a few themes. So Bill Gross, Idea Labs, right? Pasadena. He's got a incubator and has been doing it for a long time, very successfully. These are his 5 key success factors to doing startups. The top, which is to me the heart, you can't control it necessarily. It's really timing, right? So in other words, if you're going to 40 years ago, if you're going to introduce personal computing software, and there's no personal computers, it's kind of hard to build a successful business, right? So sometimes you have to have technology trends that make sense. Think about generative AI. Why is now the right time and not 10 years ago, right? So there are certain technology trends from hardware, software. You look at the cloud and doing software as a service businesses, right? It's a good time to do it. And it's been done by Salesforce. Salesforce built on top of that platform and is out competing the traditional Oracles, et cetera, who were in the license model versus buy it by the user per month, right? So timing's really hard to predict because you also want to get into a market before there's 5 competitors. Because the reality is in most markets today, the first one that's successful in deploying their solution into the market is probably going to grab 70% of the value from that market, right? Look at Uber versus all the other guys, even Lyft, right? Uber's worth a lot more. So you can go through, and there's a lot of analogies. You look at Salesforce in sort of the CRM, software as a service world, they're crushing it. USC grad, right? Who created Salesforce, Mark Benioff. But timing is always hard to predict because when I look at companies, and I invest in early stage companies, so many times maybe the founders raised nothing or they're raising a couple million. It's typically ahead of markets. And when I think about how do I fund the company into the future, I'm thinking about, can we keep the company small enough so that when the markets take off, this company will have a pole position, right? They'll be able to garner capital because they're in a market that looks to be promising. Team, we talked a little bit about that, right? I would suggest the word is ecosystem. So it's advisors, right? It's friends, it's executives. It could be corporate partners. Your team has relationships. You can leverage other people's technologies or solutions or distribution channels. It's those relationships that are super critical. Idea, when you look at this, you would go, wow, I thought the idea was everything, but it's not, right? I mean, timing, as far as your percentage, is a little bit hard to read here, but idea is like half, almost half as important as really the timing. Business model. The good thing about business models today is you can experiment a lot, much more than in the past. And then the last, which is the smallest component, according to Bill Gross, is funding. And you go like, oh, I thought that was exactly the opposite. It's like, it's not exactly the opposite. Put it this way. If you have a great idea, the time is right where the markets are taking off, you have the pole position, you've got a team that's killer, that's done it before, you have a vision for how the market evolves, and you've got a business model that's killer. Do you think you can get funding? Totally. So this is a misperception that a lot of people have. You get the cart before the horse. And the reality is, when you look at a lot of these areas, you can do a lot of homework, you can do a lot of research, you can do a lot of ideation, et cetera, before you even start a company. So, assuming you're ready to go, you've done your homework, let's look at the stages of funding, okay? So the first one we call pre-seed. There's different terms that are popping up now. Friends and family would be considered the first round. It could be 50,000, 100,000, sometimes a couple 100,000, but it tends to be pretty small at a lower valuation, okay? Each step that startups go through, the goal is to take some key risks off the table, right? Which then builds more value. So for instance, maybe the difference between the pre-seed and the seed startup round is we're going to have some sort of working prototype of whatever product or service we have. Okay, so you'll see that if I'm able to raise, 100,000, 200,000 in the pre-seed round, in a seed round, 2 to 3 million is a reasonable thing in today's environment. But the valuation also changes. I think 10 to 100K for a valuation of pre-seed is kind of not my world, because we're looking at companies, to be honest with you, that can be worth 500 million or $1 billion over time. So this would be for more mom and pop, but fundraising, the structure of this is right. And so you'll see there's several $1 million that the startup seed. You will understand here there's micro VCs, some banks. Before Silicon Valley Bank blew up, it was easier, but there's loans from banks that sort of get involved in this area. And then we go to the early stage. Early stage, I would say, is then where institutional venture capitalists get involved, right? And they're going to write much bigger checks. Many times you'll see that be like $10 to $15 million of capital going in at valuations that could easily be in the $30 to $60 million. As you go between each stage, again, you're taking risk off the table. It's easier for investors to envision a world where, wow, this could be big. And so you're going to see at an early stage like this, where you're asking for some pretty good sized money, you're going to actually see a bunch of customers. This tends to be a delineation of, in the SaaS world, of $1 million of ARR per year or more. And that moves around depending on the financing environment. And then you get into the growth stage. And there are different venture capital firms that are typically focused on each of these different areas. And so here you'll see sometimes hedge funds that are coming into growth stages. You'll see a Fidelity or other large money managers. They need to deploy a lot of capital, but they need you to have customers, a repeatable business model, everything kind of defined. So when one thinks about this, I've tried to boil it down to, if I was going to start something today, what would I do? Well, hopefully this sounds familiar based on some of the problem sets, some of the issues that we've described. First thing is develop a vision, right? An idea that builds on the founders or the executives' experience base, right? I look for people who deeply know an area and are world-class in some way, right? Okay, and then get advisors. I talked a little bit about that, right? And industry-specific conduits to help you get into companies. Validate the markets, which you can do, either yourself or work with others. Go to the MBA students, right? And ask them to help you out. Articulate a business model that's likely. Document your company culture. Now, that's really important to me. And it's really important because it impacts who you hire, how you treat customers, how you treat suppliers. If you look at millennials and Gen Zs, which is an increasing number as a percentage of the working population, over 70% want to work not just for profitable companies, but missional companies. Recruit operating executives. Patent IP for companies that have deep IP. And IP is important, especially if you ever go to sell your company. If you want to sell it to Microsoft or a lot of companies, they'll want to know what your patents are. And it's not that it's an end all. It just means they have something to hang their head on that it's somewhat protective, right? You can always reverse or get around different patents, but it is important. At that point, once you've gone through all that, then seek funding. So there's a lot of free resources out in the community. This is two law firms, one Morrison Forster. On a rolling basis, they run a 10-part series where they, and it's free, complimentary, yay. A lot of things in the Valley are free, besides Facebook and Gmail and a few other things. But they have a good program that talks about patents, incorporating companies, things of that nature. A question that I get asked a lot by entrepreneurs is, how do we value our company? Well, Wilson Sonsini, one of the best known, if not the best known law firm in the Silicon Valley and elsewhere, but started in the Valley. They actually put out data each quarter on terms, valuations, things of that nature. So I've just listed two. There's a ton, right, that you can tap into. So I'm happy to answer questions later.
Or we can take a few questions now.
Can we? I want to make sure we've got enough time, but okay. And any questions in the group here or any questions from the audience? I'd be excited to answer them.
I have a question. So you mentioned that you thought it was easier today to experiment with different business models. I remember when I started a company, we spent a lot of time figuring out what the business model was and then transiting from one business model to the next. So what do you think has changed? What makes it easier today to change business models?
I think there's a greater acceptance that you can, especially with the SaaS revolution, I think there's a better appreciation that you can do something different from a business model standpoint that's not traditional. And so it's really been an evolution over the last whatever number of years. You look at freemium models, right? You give away part of your product and you charge for other parts. So there's been more experimentation as the industry has grown, as the IT infrastructure has gotten more robust. And to be honest with you, it's the consumerization of a lot of the IT infrastructure, where if Google's giving away search and other things free, it makes Microsoft wanting to charge you a lot of money for your email. It's got to get Microsoft to change, but that's where an innovation allowed different business models to flourish. Right. And then you have a whole ad infrastructure that was built on top of giving away some things free. Good question.
Other questions? Yeah.
What point would you seek pre-seed funding or seed funding? How do you know what time to do that?
Yeah. So that's really business dependent. I'll give you two examples. One, if you're going to start a consulting business, that is what we call it capital efficient. It doesn't require much capital. If you're going to start a semiconductor company, and I've got one of those right now, you're talking millions that you really need to think about it. Because when I invest personally, I have a seed fund called One Flourish, but when I personally invest, many times at that very first round, I'm trying to think about who would I take this investment opportunity to? How deep a pocket do they have? What's the probability that it will get funded? And what has to be demonstrated before they can raise a lot more capital, right? Because when you think about investors are always thinking about risk reward, right? At the beginning, you risk a small amount of capital on the dream that it can be big, right? And as the valuation grows, as companies need more capital, they have to demonstrate more, because as you get further along, people have bigger checks and they demand more of the risks already have been addressed, right? And so one of the differences has been maybe over the last 10 plus years is companies used to go public sooner. They're staying private longer. And part of that is a reflection of a lot of capital from the public markets have moved into the private markets to help fund the companies. So then companies can experiment or do different things out of the glare of a quarterly earnings announcement, right? So it's enabled different types of businesses to flourish because there's more money in the private markets. It's a good question.
Online question from Daniel Napersky. He said, how would you describe the funding environment now, given the recent events at Silicon Valley Bank?
Okay, and I would go back. So that's a good question. And you have to remember, so let's put it in context. I got in this business in 1987. There's a few thousand, no, probably 1,000 venture capitalists or something. It's very small. Now there's a gazillion venture capitalists. Everybody calls themselves a venture capitalist. That's okay, right? The amount of capital in the venture business, I think I was reading last night, where there's investment funds that haven't been used yet. They're sitting in the venture capitalists' pockets. During times like this, they say venture capitalists have deep pockets, but short arms. Can't quite reach down to get all that money. But there's something like $590 billion of capital that wants to invest in the private markets. That's a lot of money, right? It's a lot of money. And so what's happened, especially with COVID, is the money exploded into the private markets, but that's been a gradual step up over a period of time. And it's partly an appreciation that the public markets, it's really hard to outperform them. And there's many fewer companies. And so asset managers like endowments, I used to work for Harvard's endowment, right? Harvard, starting many years ago, became a big investor in private equity and venture capital and buyout funds and growth equities. And if you look at a lot of the asset managers, they're making the argument that people, individual investors, corporate investors, endowments should go more into the private markets. I remember hearing a fact many years ago that, and I never verified this, but for a venture firm, half of their appreciation in owning an individual company stock was in the private markets, and half of it was in the public markets. So when you have a highly efficient IPO market, public investors could go for the ride. Now, when you look at the IPOs that you've seen recently, you know, they're flat to down, right? So that spread, the ability to participate is not there the way that it used to be. And so you have a lot of public asset managers investing in private markets because of this arbitrage. You had a question, I think, and I think we have time for one more, maybe.
Say that you have a product or a vision, but it's not going to be into market, let's say, profitable in a year or 2 years from now. What do you do in the meantime? Do you wait and build a product platform with federal grants, or you go into the market right away?
Okay. Generalities are hard to address, right, is the first thing I would say. I would say, though, overall, if you expect your markets to be there in the next 3-4 years, that getting all your ducks lined up in a row, and if starting a company is fine, but you have to learn to keep your burn rate low. And then when you see the markets move, then you can do that. But look at it this way. If you think a market's going to move in 3-4+ years, You can go probably find corporate partners which share your opinion. If you can't find anybody who shares your opinion, you're either an outlier, which sometimes works, or you should wait, right? But you continue to get market feedback. You continue to enhance whatever your solution is. Sometimes you can scale things very cheap, especially if it's a piece of software that can be delivered through the internet. Not a lot of compute power, right? Some of the new AI applications are probably going to kill, Microsoft and Google and stuff like that, the generative AI, right? They have a whole business model issue going forward. But leaving that on the side, there are some areas which are not highly competitive either, where you can help develop a market by working more closely with companies. And many times they'll pay you ahead. And the reason they do that many times is they want to influence the product or service, right? So there's a quid pro quo that goes on. And if you're able to raise capital from smart investors who understand your industry, and you can say, look, here's where technology is going or business models or whatever, I think we can craft a company. And when the market takes off, we're going to have distribution locked up. We're going to have, these customers that are helping us develop our solution, and then we'll become references to the rest of the industry, right? So there's a lot of ways to play it. And it just depends. If it's going to be 10 years out, I'd say, don't even think about it. 5 years out is kind of pushing it too. Unless you can create some sort of business near term. Because Scott Cook, founder of Intuit, right, and USC grad too, I heard him give a talk to venture capitalists once, and he goes, startups are about momentum. You either have it or you don't. If you ever lose it, it's really hard to turn a company around. So I look at it, capital, customers, et cetera. It's like it's a logistical supply chain. You don't want to outrun your supplies. You don't want to get too far ahead of the market or people who can help you, et cetera. And so market timing is super critical. It's the bet I want to make. I like to invest in deep tech. And if I get it wrong, then I screwed up. Because typically I can dimensionalize most technology risks. To me, that's not as big of an issue as we just couldn't last long enough to get a market. That's the bet I personally want to make, right? I want to invest in a good team who knows the space, and we can look at all the trends and say, let's go for it here. That interests me a lot. A lot of investors will be cautious about that for various reasons. Okay, so I've taken more than my time. Thank you for listening.